Question 126. The process of assessing the risk involved in making a mortgage loan is called A. Loan assessment, B. Loan appraisal, C. Loan underwriting, D. Loan applicant estimator. Correct answer is C. Loan underwriting. Loan underwriting is the process lenders use to evaluate the risk of lending money to a borrower. It involves assessing the borrower's creditworthiness, income, assets, and the value of the property being used as collateral. The goal is to determine the likelihood that the borrower will repay the loan. Question 127. Anyone acquiring an ownership interest in real property subject to local taxation must notify the county assessor or recorder by filing the change in ownership form within of the date the sale is recorded. A. 3 days, B. 1 week, C. 1 month, D. None of the above. Correct answer is D. None of the above. In California, when a change in ownership of real property occurs, a preliminary change of ownership report, PCOR, is typically filed. This report provides information to the county assessor for property tax assessment purposes. The PCOR is ideally filed at the time of recording the deed. If the PCOR is not filed at the time of recordation, the property owner has 45 days to respond to a change of ownership statement that the assessor may mail out. If the PCOR is not filed within 45 days, the assessor may mail a change in ownership statement to the new owner, who then has 45 days to return it. A failure to properly notify will incur a penalty. Question 128. The term mortgage warehousing refers to A. Grouping of mortgages sold on the secondary market. B. Collection of mortgages stored in a large commercial structure. C. Mortgages extended to commercial builders. D. Mortgage records kept on paper rather than electronically. Correct answer is A. Grouping of mortgages sold on the secondary market. Mortgage warehousing involves a lender, often a smaller lender or mortgage broker, temporarily holding a group of mortgages before selling them to a larger investor in the secondary mortgage market. This warehousing allows them to accumulate a significant volume of loans, making them more attractive to larger buyers. Question 129. In business, liquidity refers to A. Whether the business can be sold within 90 days, B. Yearly receipts, C. Current assets and current liabilities, D. Bank deposits. Correct answer is C. Current assets and current liabilities. Liquidity in business refers to a company's ability to convert its assets into cash quickly to meet its short-term obligations, current liabilities. This is measured by comparing current assets, assets that can be converted to cash within a year, to current liabilities, debts due within a year. Question 130. If a purchaser with a land contract is paying taxes and insurance premiums into an impound account, those payments cannot be disbursed for a different purpose without the consent of the A. Seller, B. Beneficiary, C. Payer, D. Tax assessor. Correct answer is C. Payer. While the seller retains legal title, the payer, purchaser, is the one making the payments into the impound account specifically for taxes and insurance. Because the payer is the source of the funds and is paying those funds for a specific purpose, they retain the right to dictate how those funds are used. The impound account is, in part, to protect the payer's interest by ensuring that the taxes and insurance for the property are paid. Therefore, the payer has the right to say how those funds are used. Question 131. The contract of sale is also called each of the following, except A. An agreement of sale, B. Installment sales contract, C. Unconditional sales contract, D. Conditional sales contract. Correct answer is C. Unconditional sales contract. Contract of sale. This is a broad term for an agreement where a seller agrees to transfer property to a buyer for a price. A. Agreement of sale. This is a common synonym for a contract of sale. B. Installment sales contract. This is a type of contract of sale where the buyer pays for the property in installments over time, and the seller retains title until the final payment is made. This is a form of conditional sales contract. D. Conditional sales contract. This is a contract where the transfer of ownership is contingent on certain conditions being met, like full payment. A land contract or installment sales contract is a type of conditional sales contract. C. Unconditional sales contract. This is generally not used. Most real estate sales contracts have conditions. Therefore, unconditional sales contract is the term that doesn't fit with the others. Question 132. Convertible adjustable rate mortgages, ARMs, can be modified into A. A fixed-rate loan B. Short-term loan C. ARMs cannot be modified D. None of the above. Correct answer is A. Fixed-rate loan. ARMs are a type of adjustable-rate mortgage that gives the borrower the option to convert the loan to a fixed-rate mortgage at a specified time during the loan term. This conversion feature provides borrowers with flexibility and the potential to lock in a fixed rate if interest rates rise. While some ARMs may have shorter initial fixed-rate periods, the convertible aspect specifically refers to switching to a fixed rate, not a shorter loan term. Question 133. If a counteroffer has been made, then A. The original offer is terminated. B. The original offer has been modified. C. The offeree becomes the offeror. D. Both A and C. Correct answer is D. Both A and C. While the counteroffer changes the terms of the negotiation, it doesn't modify the original offer. When a counteroffer is made, it effectively rejects the original offer. The original offer is no longer valid. In a counteroffer, the person who was originally the offeree, the one receiving the offer, now becomes the offerer, the one making a new offer. They are proposing new terms. Question 134. The California Standardized Purchase Agreement form gives buyers this much time to either remove appraisal and loan contingencies stated in the agreement or cancel it. A. 15 days, B. 21 days, C. 1 month, D. 3 months. Correct answer is B. 21 days. The California Residential Purchase Agreement, RPACA, typically provides buyers with 21 days to remove appraisal and loan contingencies or to cancel the agreement if those contingencies cannot be met. While this can be modified by agreement, 21 days is the standard time frame in the form. At the end of the default period of 21 days, unless a different time period is specifically agreed to, the buyer either lifts the loan and appraisal contingencies from the agreement or cancels it. Not until the buyer lifts these contingencies can their deposit be forfeited. Thus, a buyer has no money at risk until this occurs. Question 135. In a suit brought by one broker against another regarding a disputed commission split, the plaintiff will not be required to produce a written agreement regarding the commission because A. All real estate contracts can be oral and still be binding. B. The regulations of the real estate commissioner exempt commission splits from being in writing. C. Judges know that commission splits are commonly arranged between brokers. D. By law, commission splits do not have to be in writing to be enforceable. Correct answer is D. By law, commission splits do not have to be in writing to be enforceable. The statute of frauds, the legal authority for which kinds of contracts must be in writing, does not include commission splits. While it's always best practice to have a written agreement regarding commission splits, they are generally not required to be in writing to be enforceable. Therefore, a plaintiff broker in a dispute would not be required to produce a written agreement.